Hello everyone and welcome back to lesson 5 of the cryptocurrency course. Now in this lesson we will be going over grid lines. Now grids or grid lines, however you want to call them, however you want to refer to them, are the grid lines you see in the background, which is something you can easily adjust on your TradingView platform by simply right clicking, going to settings, going to appearance, and then you can see vertical grid lines and horizontal grid lines. So if we were to change the color of this, you could see the vertical grids would then be changed, and you can see over here, if we were to do the same, just to show you the difference very quickly, the grid lines are what lies at the back behind the candlesticks. Now obviously we do not want our grid lines looking like this, because although I will be showing you how to make them as beneficial as possible, it doesn't mean we'll be making them this obvious. So I personally, when it comes to trading or charting, I like to put my grids, let's go back, there we go. So I like to have my grids minimal in the background, subtle enough that they are visible, but not strong enough that they actually dominate the overall price action. And as you've probably gathered from the first 4 lessons of this course already, the goal here is to show you how some of the most simplistic things are often the most beneficial when it comes to your trading. So whether you are using the log chart or not, or whether you're using the normal chart, grids are incredibly beneficial for identifying and almost aiding your bias to naturally start identifying key turning points in the market and key levels of support and resistance without always having to plot every single level on the chart, or more importantly, showing you where to plot those most dominant levels on the chart. Now, as you can see, in simple terms, the grids are associated with the price and the dates over here. The verticals obviously being for the dates and the horizontals being for the price points over here on the right hand side. Now, if you were to drag and stretch this up and down, as you can do so on TradingView from the right hand side where the price is, you will notice that the grids slowly, the more you push downwards and the more you minimize the chart and flatten it, the wider your grid gets. The more you zoom in, the more detailed that grid can get. And obviously if you go to like a 1 hour and you really just zoom in, you can see it gets very, very tight and provides many different levels. Now, the point of this lesson is to show you how you can utilize by double clicking the trade and the chart, well, not the trade, the chart will go back to a standard default. So if you double tap here and it resets to a fixed diameter and a fixed width, you cannot drag and stretch the chart and move it. But the minute you move the right hand side price point here, you are then free to do what you want with the chart. So this is how you unlock the chart, essentially. If you double click when you naturally or first join TradingView, you will not be able to do this unless you just stretch. So looking at this overall, if we were to go to the standard, we can see immediately the grid corresponds with the price points that are most crucial, and the wicks also react to the most crucial price points that are forming this grid. So if we were to just mark off the bat straight away some key levels, you would be able to identify, make this blue, straight away. There's so many different levels we can plot here, but just to show you for the sake of visibility first of all, if we just mark loads of these grids out there, keep mark that there, keep mark that there. So in a nutshell, as you can see, by just making those horizontal grids a bit more predominant, you can easily see straight away how they become solid levels of support and resistance. Because at the end of the day, whether you're looking at supply and demand, support and resistance, or whatever it is you are looking at, it is a certain price point in the market. So if we are using something that is directly affiliated with the current price points and an easy viewable method on the charts, instead of having to draw a million different levels, we can plot our main key levels using these grid lines. And this also goes perfectly hand in hand with the wick lesson and the candlestick lesson that has been provided. So this lesson isn't necessarily too much in depth, but it does bring a very refreshing perspective into how you can identify chart structure quite easily. So if we was just get rid of this very quickly, the first thing we want to be doing, let's just do our top-down analysis as always, bring the chart back to a normal standpoint, stretch it out a bit. When it comes to wider time zones or higher time frames, you want to have your grid a bit more wider, and some of the best ways to do that is to stretch it out as much as possible so only the most dominant levels become apparent. And you'll start to see now how, by identifying these key levels, you can actually plot crucial levels of support and resistance from your top-down analysis with relative ease. The first level that becomes immediately apparent, again, this will come with a more trained eye over time as well. The more you practice, you will naturally identify a crucial level and a crucial turning point in the market. Immediately, for me, two levels come up straight away, and that is 20 cents here on the first grid. If I stretch that out a bit, you can see that is around 20 cents. So let's minimize this again. There we go. We will now make that 20 precisely. And we will also then mark one more level above here. As you can see, 50 cents. As you can see over there, the perfection there, all the candle bodies being respected. So what we do is we plot our main levels. And this is also a good way, now that we go back to normal, to easily see the current trading range. We are using XRP for this particular example, but in simple terms, by simply just marking out those crucial levels there, once you start zooming in, you can then accommodate for potential areas of further volatility within the current trading zone. Remember, the easiest way when it comes to a trading standpoint is to identify the current structure of the market and identify within a particular zone, that being the roof, that being the floor, aka support and resistance, and then finding out how you can trade opportunities within this current structure to then progress forward over time. So what you could do is, and this is just one example of how you could actually structure your charts to cater for potential swings in the market. Looking at examples like this, where the wick here was around 0.173, we look at the wick here around 0.17. If we were to just zoom in ever so slightly or even a bit more, we can see if those levels do correlate approximately with another grid line. And as we can see, the overall rough area is around 18 cents. So what we could do in this particular instance is plot a grid at 18 cents, and then just below where the wick is can be our zone. So if we was just mark that out there, this zone would be almost a threshold, almost like a boundary from the main levels of support. So this will be a key area of weekly or monthly support. But overall, we want to use the weekly for this example. And then up above, we can look for the exact same. So we're creating a boundary, almost like a safety buffer of where price can potentially go if it is to breach the current key areas of weekly support, long-term support, and long-term and weekly resistance. So looking above, we can see a few wicks spiking up into this region. Again, we're using confluences, candle bodies, and wicks in line with the grid lines to easily identify these areas. It's a bit more choppy on the upside because a lot of the upside movements have been fairly parabolic, so it can get a bit messy. But all in all, if we look around here, we can see around 51.5 cents approximately. We can see almost 51 cents there. We can see a few spikes through the 52 cents region here. So we can have a little play around. And we can see, once we start zooming in a little bit more, that all in all, that 51 cents region seems to be the area where we can find the most confluences. It's not necessarily perfect, but when you now see the buffer in between these levels, we'll go to the monthly and have a look at that as well. One of the key monthly wicks actually peaked around this region. So as you can see here, although if you dragged it a bit lower, it would be a bit more relevant, you can see overall, you now already have a key threshold and a key area of trading activity. And obviously when you plot it here on the weekly, support, resistance, spikes through. Remember, no candle body closures above. We've got some wicks, but no candle closures above besides a few breakouts. And then you can see more clearly that false breakouts towards this area can occur. Now, we could easily use grids up here to stretch this out even further, and it would still be correct. But obviously, if you're looking to trade, you do not want to have a zone that's too wide. That's one of the most important things when it comes to trading. If we were to have a zone all the way up here as an example, which still correlates with the wicks and the grid lines, it then makes your zone so big that by the time you get over to the daily time frame, or by the time you start shifting over to these kind of charts, you start to miss out on key potential moves in the market because your range is so big. You want to be trying to get an overall basis of an extension of how far price will go, but at the same time you want to keep your zone fairly intact. So that has removed itself for some reason. Let's go back to the weekly. So as we can see from there, and then the second zone, if I recall, was here at 50 cents. So we've got 50, and here we just want to round that up to 51. Again, when it comes to key levels, it's always wise to try and get the round numbers if possible, the cleanest numbers you can physically get, because overall, you know these are key price points where price will respect. So what we could then do is go to the daily, have a look at some of the wicks over here, because remember, we haven't created our buffer on the top end yet. So immediately we could use some wicks over there as guidance to around 521, maybe 52. Let's do 5200. We may need to fix that again anyway. But then when we go over to the weekly and drag this the whole way over, we then stretch this out. We now have, we'll actually have to do the same over here just to stretch it out a bit more. And remember, one of the most important things as well, and I think is a valuable lesson to be learned from this particular course lesson, is that spending time on absolutely perfecting your chart structure will reap massive results over the long term. If your levels are incorrect, and this is so important, if your levels are incorrect, you will not be able to successfully trade, or you will not be able to successfully decipher the current momentum, the current trend, or the current bias of the market. If your levels are completely off, you will be looking, let's just say this zone here was a reversal zone for you. Now granted, it did happen there, but imagine you entered short here because you just saw a downside wick here and plotted a zone. If your levels are not optimized from a higher time frame perspective, you will start plotting levels that you believe is support and resistance, and without spending a lot of time, it's almost like chart maintenance. You want to maintain the charts. You want to continuously adapt your levels over time as the chart starts to progress and price action continues to form and new candles are formed. You update this. If this was to just break and start going all the way down to zero, what we would do is we would get rid of the upside, and then we would drag that down. So the support floor would then become the new resistance, and the resistance would then become new support. You could do it either way, but this would clearly still be a valid level. It would just be broken support turned resistance. So once you've got that key structure in place, you're then able to adapt and improvise when future price action eventually unfolds. So a good example would be if this was your zone instead, and you went to just going short here, obviously with a stop loss that large, you would have been successful, but that wouldn't have been the case. So even with a relatively small stop loss, you would have seen a wick like that would have wiped you out. And unfortunately, in many circumstances and situations in the market, we cannot always predict the huge weekly candles like this. But just remember, these weekly candles are often huge moves like this, but sometimes on the daily time frame, it can be a huge candle body all the way to the top, and it can still pull back. So sometimes they're not even wicks like this on the intraday or intraday time frames. It's only if it rallied up, let's just say, throughout the week early, and then by the end of the week it went back down, it would still leave the same result on the chart as a huge wick on the weekly. So sometimes the weekly wicks can be deceiving in terms of huge price manipulation. But once you look on the intraday perspective, you would just see that price simply went up, hit resistance and pulled back. But then on the weekly, that looks like a huge wick, which in essence would still be considered some form of manipulation. As when it comes to crypto, as I always state, the weekly, the monthly is very, very important, and you do not want to underestimate those particular levels. But now that we've got this done, now that this is all cleaned up, let's have a look at the next levels. So we will get rid of this. We will now zoom in. We've got our nice rough approximate trading range over here. We now want to be looking at potential levels in the market, still using the weekly if necessary. You can then refine these a bit later on to identify the current areas of support and resistance. And sometimes the best way to do that is to still mark out the crucial levels by slightly stretching or minimizing the chart, almost compressing it before we get too clustered, because the more horizontal lines we have, the more confused we will get. And you'll start to note that very clearly all of the horizontals are respected in one way or another, but just by slightly minimizing and getting rid of that, we start to identify crucial midpoints in the market. Now, over time, you will not need to mark these out because, quite frankly, you'll be able to identify these relatively quickly. I personally do not do this myself anymore on the charts, but from a training standpoint and to get you trained into identifying the power of this, you will start to see how this can really aid your overall understanding of chart structure and the current bias in the market. So here, that would be 40 cents. Now we have 30 cents and 40 cents. And ironically, if you actually have a look on the XRP example, this is sometimes the best way it works. Quite simply, 20, 30, 40, 50. If we go higher again, this is a very good lesson for XRP as well, it tends to respect in 10-cent intervals. So quite clearly we can see here again, spiked up, false move, wicked through, dumped. Spiked up, false move, 2 wicks tapping into this region, candle bodies closing there, a perfect spike there. As you can see, it broke through, retested. This is also a valid level. If we go up to 70, the exact same applies with prior price action as well. So by simply doing this, you now understand, and this is why it can almost aid a bias when going over to the daily of where price currently is. If you do not really understand the overall market structure, you may be looking at something rather bullish right now for XRP. But because we are actually underneath at present a weekly and daily resistance level, it kind of increases the opportunities at present that it could continue lower, because it broke through, it then broke all the way back down. So it broke through resistance, came back down as support, we saw some false moves, and then yet again we have closed back below. So you can almost identify quite quickly that if price remains below this level, it will likely then fall 10 cents down towards the next region, even pushing a bit further. Ironically, this level that's marked out here and this level that's marked out here is one of my next potential buy regions for XRP. And this is just one of the methods alongside the wick lesson and the candle lesson that is aiding me in my bias that if we see a move lower, we should very easily come into this region where I will accumulate more XRP. So that is it in a nutshell. As we can see here as well, we rejected, but then we broke through. That now invalidates the level. And once this level was broken, it went straight down to 30 cents. When that level was broken, it went down to 20 cents. When this level was broken, straight to another 10 cents higher. When this level was broken, 10 cents higher. When that level was broken, 10 cents higher. But this time, the candle bodies went up. Then, by the end of the day, we closed back below. This was the major pump and dump. But guess what? We closed underneath the 70 cents region. So instant market correction back down to the 50 cents area. We went down 60 cents, we went back lower. Candle bodies maintained above. So what does it do from there? It goes up another 10 cents towards 60 cents. Failed to break, back down to 60 we go. Then we broke through, false move, but then we came back down again because we maintained 60 cents. As we can see, we held, so naturally we go down another 10 cents, straight to 50. And then from there, the dump continued. So now we're seeing a very similar situation where we need to evaluate how this level will hold. And as you can see, if you were intraday trading, all you would be doing is looking at those wicks and seeing how they are currently holding. A good example would be this particular level here. So this is where the grid of around 24 cents is. So this is where you can start going away from those clean whole numbers and start shifting more towards the numbers that end a bit more in between, almost like a midpoint in between each level. So here we could see this level was currently holding, but there was a progressive momentum higher, because if you were to mark another level on the grid here, you can see it held, and then when it broke through this level, it kept holding the next grid line as support, eventually breaking higher, which then of course took us to the overall main levels. So what we will do for the sake of this video is make these levels blue actually, because these are the key 10 cents regions. For XRP, it honestly doesn't get more simple than this. I mean, I can do it all the way here if need be. We'll make that blue. We will then duplicate that one more time just to bring that up to 70. And there we go. So now we have key market structure. We've got our boundaries there, if need be. Again, because we're trading in the current areas, you could leave them here as well, just to let you know that the overall trading region is currently fixated between this boundary. However, if you want to, you can always get rid of that as well and just keep it very simple and work on a basic 10-cent structure. That can often be the easiest way to do things. And then from there, now you are on the daily. If you were to just zoom in ever so slightly, you can see very simply, instantly, key points on the grid, which allows you to not only correlate crucial turning points in the market, but also understand the kind of intermediary between those two levels. So naturally, in the instance of XRP in particular, where this works brilliantly, now you can split that down into the 5-cent differences. So that would be 25 cents. Then we would go to 35. Then 45. 55, and one more, 65. Now, obviously, this is chaotic, and even though it is simply just horizontal lines, it can still get a bit overwhelming and a little bit messy. But if you were an intraday trader, what you could basically do is you could structure your chart like this in the beginning, whether that's from a weekly perspective, and then you've got the grid lines in correspondence, so they will stick to your grid lines, obviously. Nice way to mark them out. You could also make these fainter, so they're very similar to the grid lines you have, but all you're doing is just making them a little bit more visible, but at the same time they're still relatively small. So you could even do that. This is quite a good way to do things. As an example, you could also do that. So it depends on your visibility. So if you want, we can actually do this. I know this is a bit lengthy, but it will pay off. So what we'll do is I'll quickly do this, then we will skip to the next segment. Right, so there we have it. I thought instead of boring you to death, I'll get the messy bit out the way first, and then we can go straight back in. So as you can see now, all we've done is simply illuminate the horizontal grid lines ever so slightly to now see the difference between the key 10 cents regions, and then split that down into the 5-cent regions in between as well. So now very clearly, from a long-term basis, if you were looking for long-term targets, or if you were looking to swing trade, you would need to simply ignore these levels. You could either hide them to get rid of them. So if I was to get rid of all of these, you now have easy targets to trade in between, as we can see. If you were to enter long here and target the next 10-cent region, you very easily be able to start identifying potential areas of risk to reward. If you were long-term trading and you were going for bigger targets, all you would do, if you wanted to really play it safe, is just put stop losses near another 10-cent region below. But obviously that is quite large, so you wouldn't always want to do that. But from a basic standpoint, you are able to then potentially capture easy swings between these crucial price points. But what you could also do, especially if you want to go for more frequent trading, is when you drop down to the daily and then go down to the likes of the 4-hour or so, you're able to then utilize these next potential levels, understanding they may need some refining. Not every level is perfect. This is where zones can come into play as well. You can then utilize the key levels you've got, and then once you zoom in and you see those horizontal grids slightly more defined and slightly more dominant, a good example would be here. And remember, it's always good to switch up the colors to differentiate between the two. So what you would be able to do if you was looking for a short trade, let's just say you were looking to either enter here or wait to see how the next grid lines came about. By zooming in, you're able to identify the next few grid lines above your level. If you see candle bodies reject here, all you would do is simply place this here, enter around there, stop, depending on how zoomed out you are, maybe 2 grids above, and then all you do is aim down from this down to the next, off to the 10 cents region, and very easily you would almost be able to achieve 5% return on investment simply by utilizing these key levels. As you can see, it will not always be the case, but that is the point of trading. You never know 100% what is going to happen next, and the best thing and the best way to succeed is by sticking to 1% risk and utilizing opportunities like this. Instead of trying to identify analysis paralysis, we plot every single grid, and then what you're doing is you're suddenly blinded because there's so many levels that could become a key staple. You may enter here, and it could actually end up working out for you. You may think it's broken this level, let's go long here and target a major move there. But the next thing you know, it falls short, hasn't reached the target, and bang, you see it hit this level, then you short from here. You can get crazy, and analysis paralysis is a very real thing. You want to make the charts as clean as possible without any distractions, and this is one of the easiest ways to do this. Even if you are simply just long-term investing, this is a great way to start identifying how price may be able to react around certain levels. So more often than not, around every 10-cent region, so for example 10 cents, 20, 30, 40, 50, 60, 70, when price fails to break one of them levels, it is a telltale sign you will head down to the next level. If you go down to the midpoint, you can see sometimes those are just crucial reversal zones for intraday trades. So by marking those out and going to the 1 hour time frame, you can see over here a good telltale sign is we saw a fake break above, we then pulled back down, we then came and rejected. This probably would have triggered you in, because arguably when entering trades due to spreads, you wouldn't put your trade exactly at this level because maybe it will not come through. But very frequently the market is wicky, it's very choppy. So let's just say around this region, you put your stop loss above the prior high and you were targeting the next level down, which would have been around a midpoint. So this would have fallen just short, granted. However, it still would have been a very successful trade. If you caught profit there, that's 2.2%. If you caught profit there, that's still almost 3.5% just from that level alone. If you put this where the last high was, just in case you thought it wouldn't come back, which sometimes this would have been a very lucky trade, to be honest, because there were several rejections there, you could have made almost 4%, or in the worst case scenario, made around 3%. So this is a very simple way to really start training the eye into how the market is going to react next. And then what happens is over time, when you start naturally getting used to just zooming in and out and monitoring the chart, most importantly on the daily or the weekly time frame, when you start zooming in and out, you can see the more you reduce that horizontal mess, the more easier it is to see just crucial areas where that market is going to potentially turn around. Marking that out there, bang, these are the most important levels. And you can see here, where price has come down to respect these levels, it has been very short-lived anyway. So the main trading action at the moment is arguably right in between these key levels, from around 20 cents up to 60 cents. We have seen this many times from 2018. Price just reacts, remains above this region. And this is one of the reasons why I still had a feeling we were going to see a pullback from this region. And that's actually why, now you know exactly why, I did take the majority of my profits from 44 cents or so up to 60 cents. Because once we hit this region, I thought, do you know what, even if it goes a bit higher, overall, it is still showing an utmost respect for this level. So it kind of goes hand in hand. And you have a rough sense that once it breaks the first time, normally when it comes back again, this again, actually, in fact, this is a perfect example of what I teach you all in the Innovation Markets app, all the community members. When I show you the accumulation of the whales and the institutions, this is almost an expanded, widespread version of what I tell you in terms of, let's just go to ZRX as a good example. So ZRX in terms of accumulation, you could even maybe even go to the weekly. Yeah. So as you can see, this is all accumulation. Consolidation is another fancy word for accumulation by institutions, whales, or any kind of big hedge fund or firm. So what you are seeing is, on a small perspective, the market continuously does this. This is often a telltale sign of a breakout to come. But with XRP, you can see that many times over on a smaller perspective. If we were to go to the 4 hour, you can see accumulation occurring now. Doesn't mean it won't dump lower, but this is a sign of accumulation. But by utilizing those grids and identifying the larger swing points in the market, by going over to the weekly, what you then find is within what is now a minimal 2 to 3 week period of consolidation, the overall market, despite going downwards, is still consolidating upon a certain key level from a support perspective and a resistance perspective. So in general, there isn't too much to this lesson to really cover. The most important thing is actually just understanding how these grids come through. You could literally go to the 5-minute chart, which I do not recommend for trading, but as you can see, by simply just going to the grids and aligning them with the wicks, your eye will instantly adapt to identifying key potential levels. If you were literally swing trading or even scalping, you could have come towards this level here, stop loss below there, just above, you would have made almost 2.5%. You probably would have actually hit 2.5% or more by simply utilizing these particular levels here. Rejections here, rejections here. Using the grids, we've got a grid there, and we've got a grid down here. You either enter from the first level upon this retest here, which you could have done, stop loss above, and then when it eventually did come down, that would have been almost 2% when it finally reached target. So there's many different ways to utilize this, but the most important take home from this lesson is the grid lines are literally a saving grace, and they are something that it seems to be this big misconception in trading where people do not utilize the tools that are given to them. The charts alone, the candlesticks alone, using the grids is almost all you need, or at least the basic core fundamentals of what you need to succeed in trading. Indicators, I do not believe in them. I may provide a moving average tutorial for a more longer term perspective, but all of these indicators, they are predominantly lagging indicators, which means you're applying historical and lagging information to a chart that is presenting you with all of the real-time information you need to succeed. I've used to use moving averages quite a lot, I must testify to that. However, as time has progressed, my charts have become cleaner, hence why you can see the same candlestick colours. Any form of psychological implication on my trading, I eradicate time over time. And it's funny how you always learn. There is never a period in time where you will not be learning, and to become the best of your skill set, or to become the best of what you do, or the best at what you do, you need to continuously work on improving, and you need to understand that you have never learnt everything 100%. If you are the smartest one in the room, as they say, then you're probably in the wrong room. You need to be understanding that every time you look at the charts, there is something you can improve on. And I have found after all of these years, it's often the most simplistic of things that no one would even look at. The fact of the matter is, we all have grid lines on our charts. Even when we first make a fresh chart on TradingView, we all have grid lines present, but many of us remove them, or many of us do not even realize there's grids in the background. Many people use grid lines for marketing purposes, just to show and make the charts look more cool or more complex, but no, they're actually very simple, and all they are doing is showing you the dates, and they are showing you the price points. The dates are not too important, but the price points themselves is what we are using to identify support and resistance. So by using the grid lines as an additional guidance, we are in great hands here to understand market structure 100% more clearly than what we would do if we weren't using them to our advantage.